Hello and welcome everyone to a special training on bank reconciliations, financial statement preparation, and the brand new SAO reporting schedule, the Schedule 6. This training is specific to cash basis cities and cash basis counties. So with that, let's just get started. For thousands of years, we've asked ourselves, why are we here? Well, today we are here to discuss a new reporting schedule required for cash basis cities and counties for reporting to the state auditor during its annual reporting process. That new schedule is the Schedule 6, and it's the newest addition to the reporting schedule family, and it's prescribed for the exact same reasons that the Schedule 07 and the Schedule 11 were, and that is to provide necessary information to your auditor, helping them gather sufficient data for SAO to issue its opinion on your financial statements. So although the Schedule 6 is the newest schedule, and you may be looking for a detailed list of instructions as to how to complete it, it's important to remember that almost all of the schedules requested by SAO should be summaries of your local government's results for the year or summaries of events which have transpired. So just like the Statement C4 and Statement C5, which are your financial statements, are a summary level of all revenues earned and expenditures paid to operate your city or county, the Schedule 6 is simply a summary of your reconciliation of that activity during the year. So before we chat about the schedule itself, we have to touch on the financial statement preparation processes that you are probably performing at the end of the month or at the end of the year, and how these processes tie into your financial statement audit, and thus the new Schedule 6. So first of all, why are we even concerned over how your city or your county's financial statements look? Well, if people are making decisions about this data, then we need to make sure that we can rely on it and that it's materially accurate. So financial statements describe a local government's financial position and results of operations. Financial statement audits are there to check the financial statements. They give a seal of approval that, yes, these numbers are good, and you can use them to make decisions. You can rely on them to get grant funding, or somebody can trust that they're accurate in order to obtain further financing. So the statements are a product of all of your hard work during the year, recording transactions and reconciling them to identify any errors. Our audit makes sure that what you're telling us, that what happened on your financial statements, actually happened in real life and that they're reliable. So how do local governments make sure their financial statements reflect actual activity? Well, throughout the year, there are certain control processes happening, such as making sure that receipts are deposited timely, that expenditures are coded correctly, and further that there are control processes in place that make sure that all events are actually captured in your statements. One of those key control activities that falls into all of those processes is the bank reconciliation. So one of the best practices that a county or a city or any other local government for that matter can perform is a regular, timely bank reconciliation. So bank reconciliations help ensure that bank activity has been properly recorded in your accounting system. And further, that these reconciliations can help identify errors or any other irregularities in both the bank statement activity as well as your general ledger activity or your accounting system. So what is a regular, timely bank reconciliation? Well, it's one that is first regular or performed monthly. We say here at least quarterly because there are certain bank accounts, like a clearing account or a transmittal account, which the activity may not warrant as frequent of a reconciliation as your primary accounts. So for those primary checking accounts or large investment accounts, those should be reconciled more frequently, and a best practice is typically monthly. So next, they should be timely. Timely is generally within a few weeks of receiving those bank statements. You want to make sure that you do this within a reasonable range of receiving those bank statements, again, to make sure that you can identify errors in a timely fashion. Reconciliations should include both reconciliation of cash and investment balances at the end of the period, but also activities such as revenues and expenditures. This reconciliation of revenues and expenditures is often referred to as a proof of cash and is a best practice as it has a better chance at identifying specific transactions which have been made in error. These reconciliations and proofs of cash should cover all bank accounts, not just the primary account. So auditors will request all of your statements because we opine on all the cash that you hold, whether it's for your own operations or whether you're just holding it for somebody else. And last, since you already went through the effort to reconcile and tie down your cash flows, keep that work handy. Document the process, as it helps provide auditors with the support that you are actually performing these activities to ensure your statements are free of material errors. So it's the compilation of all these bank reconciliations and proofs of cash that will assist and eventually roll up into this new thing called the Schedule 6. So let's talk finally about the Schedule 6 itself. So what does it really do, and how can you use it to help in your own understanding of the bank reconciliation process? Well, the Schedule 6 is merely a summary of all of those bank recs and proofs of cash that happened during the year. So it's a summary, meaning it's not intended to replace any existing process that you may already be performing. Last, it's for this year optional. So we're allowing local governments, cities and counties to either file the Schedule 06 or continue filing the Schedule 7 and 11. Again, both are meant to provide your auditor with necessary information that they need to conduct your audit. Well, the cash basis of reporting as prescribed in BARS requires all revenues to be recorded when received and expenditures to be recorded when issued and paid. So what this means at its core is that revenues are recognized when received by cash and expenditures are recognized when cash is disbursed. That would mean, if you boil that down and put it in the simplest form, that bank activity would match financial statement activity. It sounds easy, right? Well, not really, because we all know that there are some things that hit your bank accounts which aren't revenues at all. Likewise, there are certain things that you record via your accounting software, your complex systems that don't actually affect any of your bank accounts. So all the Schedule 6 does is collect these adjustments and these differences and provide that information to your auditor. So as long as those adjustments are supported and allowable, then we would generally find that your statements are materially accurate and reflective of all of the events which actually occurred during that year. So what happens if there are differences between your bank accounts, those reconciliations which you're performing for yourself, and you're preparing them for SAO? What happens? Well, remember that differences aren't inherently bad. Most of the time they exist for a specific reason. And most of the time they're allowable because you've put forth those processes to make sure that those transactions actually did happen and you need to report them on your financial statements. Well, how does SAO view these differences? Another really great question, thank you. Well, we expect to tie ending cash to a trivial amount. We then expect to reconcile revenues and expenditures within a reasonable range. And this range is generally pretty small, typically around 1% of total revenues and expenditures. Now, ideally, this should be much less. And every local government should work towards reconciling that activity down to a trivial amount, just as they're doing with beginning and ending cash. For these final unreconciled amounts that we can't determine what they were, support isn't there to determine that they were allowable differences. They're generally presumed to be a likely misstatement. So in summary, we're looking for those items that are shown in the middle of the diagram here. On the left, we have your bank statements with beginning balances, receipts, disbursements, and ending cash. And on the right, you have your financial statements, which show pretty much similar things. We have beginning balances, revenues, expenditures, and ending balance. Well, like we said earlier, there's these things that happen in between there. There's these reconciling items. That's what the Schedule 6, and that's what auditors are going to look for. That's what they are concerned over. So you're telling us, one, here's what happened to our bank accounts. Then your financial statements tell a different story. The Schedule 6 shows that in between. It shows us those reconciling items. Now, counties we know that you have an extra layer here to your reconciliations. And for that matter, cities aren't really immune to this either. Many times the local government will have multiple general ledger systems, or they'll have multiple software systems. We generally expect that the local government will know how each of these systems reconciles both to the bank statements and to each other. Again, they don't always need to match, but they should be reconciled and differences should be documented. And remember, auditors will reconcile these bank accounts to the Statement C4 and Statement C5 in total, not separately. This is an aggregate reconciliation of all beginning balances, all cash receipts, all cash disbursements to ending cash. So let's move on to the Schedule 6 and how it works. Well, I want to remind everyone that as with all SAO reporting schedules, there are instructions and then there are templates. Please use both when filing your report. The instructions contain very important information, including examples to assist in populating the template, which is generally just an Excel file used to populate and provide that information to auditors. Let's move in now to the Schedule 6 and talk about it column by column, because this walkthrough is going to be essential in understanding both what a bank reconciliation is and how that information for those reconciling items are conveyed to your auditor during the audit. So here is about the first half of the Schedule 6. There's some columns off to the right, but we'll get to those a little bit later. What we're going to be concerned about right now are these first 9 columns. So let's focus on the first 5, at least right now. So as stated earlier, cities and counties should include all bank accounts and investment accounts. Although most likely immaterial to your total cash, we'll also need to know the balances of all change funds, petty cash funds, which are supported by maybe a lockbox with cash in it, because you also report these on your financial statements as cash. Again, those will go in columns in column 1. In columns 2 through 5, all a city or county should do is take the bank statements and enter your beginning balances, your total deposits, your total disbursements, and ending balances for the year by bank account. So this should be easy to tie back to the statements as part of a review process for compiling the Schedule 6. As long as you can tie columns 1 through 5 back to your actual bank statements, so far so good. For cash and change funds which aren't evidenced by bank accounts, no deposit or disbursement data is needed, so we don't need the additions or the reductions of those accounts unless the authorized balances of those accounts change during the year. Again, these should be immaterial in most cases, but we need to know this information so that we can tie down that ending cash to a trivial amount. So now that columns 1 through 5 are done, what's next? Columns 6 and 7 refer to cash inflows and cash outflows. That is, those outflows and inflows that hit your bank account but did not get reported as a revenue or an expenditure. And when we talk about revenues and expenditures, I'm talking broadly as any account that starts with a 3-1 through a 3-9, or expenditures which start with a 5-1 through 5-9. So these are things that did not get reported as those BARS accounts on your financial statements. So you'll still use your bank statements to determine this information. Think about your bank account transfers or purchases of investments. Yes, your bank accounts were affected by these transactions, but your financial statements weren't. Other examples would be refunds and reimbursements due to corrections of error, either because an amount was overcollected or perhaps there was a bank error where you were issued a receipt, a deposit, but these aren't really revenues. So yes, they affected the bank statements, but they didn't affect your financial statements in the same way that they're shown on that bank statement. So let's say you overpaid that invoice and received a check back. Your bank account says it was a deposit, and cash basis says deposits are revenues. Well, that's not the case here, so we have to remove that deposit out of the equation to come up with actual revenues as reported on your financial statements. Same thing with bank account transfers. Yes, you received some cash from another account, but it's merely an addition that's not reflected on your financial statements. The cash is still there. The cash is still yours. So far, we've put in our bank statement data into columns 1 through 5, and then we told auditors that there are certain deposits which aren't revenue in column 6, and certain disbursements in column 7, which were not expenditures. So far, we're doing pretty good. Now we need to tell auditors that there are certain items which you did in your accounting system, or maybe that somebody handled outside of your government did for you, which you recorded as revenues and expenditures on your financial statements, but they did not have any effect on the bank accounts that you've already listed. Those go in columns 8 and 9. So what goes in columns 8 and 9 are largely manual journal entries. So this is where it may take some time to think about how your local government codes certain transactions. So for example, how does your city or county perform fund transfers? These are accounts 397 and 597 on your financial statements. If these transfers between funds on your C4 and C5 don't have any effect on your bank accounts, then the total 397 will go in column 8, and the total 597 transfer out will go in column 9. However, if certain fund transfers did affect your bank account, then you would only include the ones with no bank account effect in those columns. Let's do another example. How about interfund loans, or maybe interfund payments for services provided by another fund? Does your city send and receive these interfund transactions by issuing a check and then receiving them into a different bank account? If so, then they wouldn't go in columns 8 and 9 because they're already captured as revenues and expenditures, as evidenced by receipts and disbursements in columns 3 and 4. However, if you do these transactions manually, or otherwise they didn't affect your bank statements at all, they're just journal entries, then we need to add them to your statements by using columns 8 and 9. So again, we're taking your bank account activity in columns 1 through 7, and now we're adding some things that happened in your accounting system that eventually resulted in revenues and expenditures. So there are some strategies here to figure out some of these amounts. For example, if you know that all fund transfers are done via journal entry that didn't have a bank effect, then like I said, you will just use the total 397 and 597 that you reported on your statements and place them in these columns. Note that interfund activity will be reported identically in both columns, meaning obviously if you had a transfer out of a 597 and a transfer in of 397, these match. So the same amount will go in each column 8 and 9. So continue with this process for specific types of revenues and expenditures. For example, how do you pay an internal service fund for services performed to other funds? How about utility taxes? Did you have any bank loans which were sent directly to a vendor for a purchase that weren't hitting your bank accounts? Any revenue or expenditure that didn't have a bank effect is a reconciling item that auditors are concerned over. You may be able to identify certain revenues, for example, without receipt numbers or physical receipts evidenced by those, as well as expenditures without your typical check numbers because they didn't have printed checks. There are some strategies here to figure this out, but most of it will take you thinking about how do I record these transactions. So we move now to the very far right side of the Schedule 6, which are our fiscal year-end reconciling items. So these should come straight from your December 31st reconciliation, your year-end rec, to tie down ending cash. So we have things like for each bank account, deposits in transit, checks outstanding, open period items, and any other positive or negative year-end reconciling item used to adjust ending cash or revenues and expenditures to get to the data that's reported on your financial statement. So these should come straight from that year-end reconciliation. So remember this graphic. The Schedule 6 will display the same data. Take a look. To reconcile your revenues, you can confirm, first of all, receipts in your bank account, less those receipts that you didn't report as revenues, plus things that you did in your accounting system that were revenues but did not hit the bank account. Finally, plus some items like deposits in transit and other year-end items that did increase your revenues. You did record these as revenues, but they didn't hit your bank accounts yet. So think about a deposit in transit. Yes, you've received the cash, you've recorded it as a revenue in your system, but it's not actually reflected in column 3 yet because it hasn't been deposited in your bank account. So we need to add those items back in. So again, we have cash inflows, which we assume are revenues because they're deposits. Some of them aren't, so we reconcile those out. Some things in our system are revenues that didn't hit our bank account. And then finally, some year-end things that we've recorded as revenues, but they haven't hit the bank account yet, so we add them back in. If the auditors have this same information, and further if it is reconciled within that reasonable range, the city or county should be confident in their financial statements. Of course, there are always other issues that could pop up, but for reconciling cash activity, this is largely all there is to it from a process level, at a summary level. We've already gotten a lot of questions just like this. Which column do I use for something on the Schedule 6, some transaction? The problem is the transaction itself isn't generally enough information for us to provide you with any sort of answer. Instead, we'll turn around and we'll ask you these things. Did the transaction have an effect on the bank accounts? And if so, how? Did the transaction get reported on your financial statements? And again, how? If you ask yourself these two things with a strange transaction and how it falls into the reconciliation process, it'll help you figure out which column it should go in on this Schedule 6. So to close out this brief training on the Schedule 6 today, I want to run through some live scenarios. We don't expect you to, at year-end, go through every single transaction like this. However, you should still know how certain items like the examples that we're going to go through affect the Schedule 6, as well as what it means to your financial statements when you're performing your reconciliation or proofs of cash. So instead of me talking about the concept of this, let's just go through the first example. Number 1, I record transfers between managerial funds, which roll up for reporting purposes, so they get eliminated. I do all transfers via journal entry. So the answer to the first question here, did the transaction have an effect on the bank accounts, is no. That means that the transfers will not hit anywhere in the first 7 columns, which were from your bank statements. The answer to number 2, did the transaction get reported on your financial statements, is in this case also no. These were eliminated. So when you look at your statement C4 or statement C5, they didn't actually get reported as a transfer in 397 or a transfer out 597 because they were eliminated. Since they had no bank effect and didn't hit your bank statements, there's nothing to reconcile between the bank statements, which means that they did not hit the Schedule 6 either. Remember, the Schedule 6 is capturing reconciling items, differences between what your bank said happened and what your financial statements are telling us happened. So let's look at another example. 2, we received bond proceeds that were deposited into our main bank account. It was recorded as bond proceeds, BARS account 391000, on the statements. Again, let's ask these questions. The answer to number 1, did it have an effect on our bank accounts, is yes. So that means that it would have been recorded in column 3. That's the column for receipts from your bank accounts. The answer to number 2, did the transaction get reported on the financial statements, is also yes. So because it hit the bank account as a receipt, and it's also shown on our bank, on our financial statements as a revenue, again, there's nothing to reconcile. Deposits do match revenues. So where would it fall on the Schedule 6? It would show up in your checking account as a deposit, and that's all there is to it. If this is the only transaction we had, the Schedule 6 would make sense. We had cash inflows, and nothing else to reconcile. That's the revenue on our financial statements. Let's take that one a little bit further. 3. In reference to those same bond proceeds, we then had to create a separate bank account to hold a little of the proceeds as a guarantee. It's reported in the same fund on our financial statements, but we had to do a bank transfer into a new account. Okay, so the actual movement of money here, we had to reduce our main bank account by a portion of it to put into a bond bank account. However, since those show as receipts and disbursements in columns 3 and 4, but they aren't revenues and expenditures on our financial statements because they're still included in the same fund. We didn't actually spend any money or receive any money in that transfer, that bank account transfer. Then we need to remove them on the Schedule 6 to come up with our financial statements. This would be the result. We have cash outflows in column 4 from our main bank account to our bond bank account as a cash inflow in column 3. Neither of those outflows or inflows get reported as revenues and expenditures, so we remove them by placing those amounts also in column 6 and 7. Essentially, what's shown here on the Schedule 6 is a complete netting of that activity, because really it did not have any effect on our bank statements. Number 4, we have a payroll ACH bank account. We bank transfer all paychecks into that account so that they can be direct deposited into our employees' checking accounts. The account always starts at 0, increases by the current payroll batch, and then is reduced to 0 when we pay it. So first, cash is disbursed from the main bank account, which we put in column 4. It's a cash outflow. This is actually probably when the expenditure is recognized too. We pay payroll, we disperse the money out of our bank account, so there's really nothing else to reconcile. We just have something in column 4 here from our main bank account. Then, I'll pop these up. Then it is deposited into the ACH account and then dispersed. Since the payroll expense is already hitting the statements from the main bank account, we have to reconcile out the deposit and disbursement activity in the ACH account, so basically it doesn't hit the statements. So where we outflow, we transfer money from our main account, we transfer it into our ACH payroll account, and then we actually spend it, we disperse it to our employees in column 4 of that ACH payroll account. The total deposit and disbursement activity of that ACH payroll account doesn't get reported on our financial statements because we'd be duplicating our payroll expenditures. So we reconcile those things out. We don't actually report that activity in our statements because the payroll expenditure already occurred from our main bank account. So all that's left here is a cash outflow from our main bank, and then the ACH payroll account activity essentially is netted and reconciled to 0. Let's do one more. We reported $56,000 on our financial statements to bars 3480000, which is an internal service fund charge for service. The general fund pays the internal service fund via journal entry, not through issuing a physical check. So asking those two questions, did it affect the bank account? And how did it affect our financial statements? This is the result. These had no bank statement effect, but were recorded as revenues and expenditures. So as shown in columns 1 through 7, we had no bank statement effect, but we do have to add that activity back in, both the disbursement from the expenditure from the general fund and the revenues received to the internal service fund in columns 8 and 9. So the total spent and received would go in those columns. You would repeat this for all other activities in which you use journal entries to record revenues and expenditures. Again, think transfers, think interfund loans, think internal interfund transactions of all types, charges for services, etc. So there's a lot of ways to get help along the way, especially this first year as the schedule is brand new. If you are stuck and having issues tying amounts, our office may be able to provide you some further examples or ask you questions to help you come up with amounts to disclose to an auditor as a reconciling item. The most important part of the schedule is not the actual Schedule 6 at all, but rather your process of reconciling your bank activity to your financial statements and finding ways to document those differences. The Schedule 6 is that way to document those differences. It is management's responsibility for the production of financial statements which are free of material error or omission. However, there are plenty of resources and ways to get help to make those important decisions. So what I leave with you at the very end is ways to get help. First of all, the help desk is the best way to get help with anything audit or reporting related. Your question, first of all, will be documented, which helps keep support for all of the decisions which you are making. You can also access the contact information here for specific Schedule 6 questions through this reporting season. We really hope this brief training, its introduction to the Schedule 6, helps make sense of it and helps make sense of what auditors are expecting from you as part of this reconciliation process. We hope this helps you tackle your reconciliation dreams in 2017 and beyond, and please let us know how we can help further. Thank you for all your time during this training, and please don't be afraid to ask for help.